I think mortgage rates are going to continue to go up. We've seen a little bit of an uptick in mortgage rates right now. So as those rates increase, that's going to kind of shrink everyone's buying power a little bit,
Yep.
and that's also going to help kind of slow the rise of home appreciation as we see that happening.
Hey guys, welcome to another episode of Break It Down with Braydon. Super excited. I've got my buddy on here, Brian Gething. Brian, thanks for joining me today.
Thanks for having me.
Of course. Got to know Brian probably the last 4 or 5 years, kind of through the business.
Right.
Met actually just kind of through passing, just kind of through business, and then kind of got reacquainted through an insurance buddy of ours.
Yep.
Brandon Cox, a quick little plug to Brandon Cox. And yeah, just been awesome kind of building our businesses together and
Sure.
just kind of reconnecting and kind of seeing what you've been doing. And
Definitely.
got to meet Brian's family the other night, his awesome wife, Sheann, and his new daughter, Sienna.
Yep.
She's 6 months now? I think
Just
you got-
past 6 months. Yeah.
Just past 6 months.
Yeah.
She's got us beat by 1 month.
Yep.
We just had our Kennedy's 5-month, I guess not anniversary or birthday or whatever. I don't know, 5-month.
Yep.
5-month yesterday.
They're gonna be BFFs. That's
Yeah,
for sure.
it's pretty cool. And they just live around the corner from us, so
Very
it's going to
cool.
be awesome to kind of have you guys as neighbors and
Definitely.
kind of watch the girls grow up together. It'll be pretty cool.
Very cool.
So Brian's a lender here in the Valley with People's Mortgage. Brian, how long you been a lender now in the Valley?
I moved out here from Ohio in 2007 and got into the mortgage business immediately when I moved out here. So we're just past 14 years, actually.
Love
Yeah.
it.
Seen a lot of stuff, a lot of changes.
Yeah. What got you into the business?
It's a good question. So I always knew that I wanted to be in finance in some capacity, and I had an opportunity to come out here from Ohio and get a job here right after college in the mortgage industry at the time, which was cranking, doing really well. I had a friend of a friend that was in the business that was going to hire me on, telling me how incredible things were going.
Yep.
So he was in the 2005 to 2007 boom
Yeah.
that was going on here. So I said, hey, this sounds like a great opportunity. Gives me a chance to move away from the cold and rain in Ohio to the desert where it's, weather's great, lots of golf.
Yep.
So I took him up on that opportunity, moved out here. About 2 weeks after graduation, I was out here and starting at my job in the mortgage business.
Love it.
So timing-wise, not the best time, right before 2008, but it was actually a blessing because I was able to learn a lot. And, I'm thankful for that now because the work ethic and the things I learned then has, better prepared me along the course of working in the business and,
Yep.
Enabled me to, build a cool team and continue to, grow the business and, be prepared,
Yep.
as things, for better or worse, there's always gonna be changes in the market. So,
Yeah. You're definitely one of those names that's been around for a while, and having that experience of going through those hard times of where the market was at,
For
13,
sure.
14 years or whatever ago, it was pretty crazy. So
It
having
was.
that experience and that wherewithal to kind of get through those times
Sure.
and still be doing this
Exactly.
is a tribute to your success
Yeah.
and kind of where you've gone.
I appreciate it.
yeah.
Yeah, it was, like I said, going through that was definitely a unique experience, but
Yeah.
I'm definitely grateful for it. And, I hear a lot, and one of the biggest objections we get now is clients saying, you know what, I just, don't want to move forward. I want to wait for the market to crash again. I hear that all the time. And if I had a dime for every time I heard that, I think I'd be retired already. But
Right, market's gonna shift.
yeah, so looking from now until then, just to kind of bring that up, I think
Yep.
it's an important point to talk about and the differences between now and then. And
Yep.
again, having lived in that environment and worked in the mortgage business during that first crash, let's call it a crash because it was pretty
pretty
devastating
nasty, yeah.
and screwed up a lot of people's retirement and gave a lot of people some really big challenges financially. So it was a tough time to work in the mortgage business at that time.
Yep.
Trying to help people, trying to get them out of their pay option arms, trying to get them out of those adjustable rates. And, they bought the house for 400 and all of a sudden it's worth 280. That's a tough conversation. And
Yep.
that was my first kind of year and a half was dealing with that. And it was really tough because I genuinely wanted to help people, but when you're underwater that much on your mortgage, your options are pretty limited.
Yep.
So, going back to that point in time, comparing it to now, builders were building like crazy. They were basically building, based on pent up demand that was artificially created because people didn't even qualify for loans and they were making up these crazy programs
Yep.
just to get bodies into homes when they had no, financial ability to repay that mortgage. And so at that time we had, 70 to 80,000 homes on the market, and people getting into mortgages that had no business in those mortgages.
Absolutely.
Versus now, very opposite on the supply and demand with, homes, a severe supply shortage.
Yep.
And people are truly getting into loans that can repay the loans. A lot of the, ability to repay, all those things are into law now. So there's no make up your income.
Talk about that a little bit more. The Ability to Repay Act. So when did that go into place? I don't know if you know the actual year, but
yeah,
you
a lot
probably
of,
do.
and Dodd-Frank was the main law that came out from the financial crisis.
Yep.
It was the first law, or I guess bill, was in 2010.
Yep.
That required loan officers to get licensed. It brought in the qualified mortgage is a term that is thrown around. It brought in the ability to repay. So basically, it said, hey, these lenders that were doing all these crazy loans, this is done with. We're not doing this anymore. They basically gave a little bit more clarity to mortgage lending, and basically set a frame of guidelines that
Actual requirements.
actual requirements, and not like stated income loans, pay
Yep.
option arms. It got rid of all that stuff. For those that maybe don't know, I mean, when I again got into the business, those products were getting kind of winded down as I got in the business. But coming in, talking to loan officers in my office, they're like, oh, just do a stated loan. I'm like, stated? Okay, tell me about that. What does that mean? Oh, you just state your income. I'm like, what do you mean? If you just tell, on the loan application, I make $15,000 a month,
Yep.
and there's no verification. Nope, you just state what you make. And it's like, okay, that doesn't sound like a good idea.
Well, then you brought up earlier that they were doing ARMs. A lot of ARMs were going on back in the day.
Adjustable rate mortgages. Yep.
So elaborate a little bit on that for people that aren't
Sure.
familiar.
And so from a actual technical standpoint, an adjustable rate mortgage can make sense, especially for investors,
Yep.
the people that want to cash flow, if they're used correctly. But what happened was, if human nature takes over, so if they say, they were called pay option arms because you had the option to make either a fully 15-year payment, a 30-year payment, a interest-only payment, or the last one, which is the lowest payment, which human nature is like, ooh, I like that low
Yep.
payment. That was called a neg-am payment, meaning it was a negative amortization.
So their equity was actually
So every time they made a payment, their balance went up.
Yep.
And so that's in a heavily appreciating market, that could still work.
Sure.
The moment things starting to flatten out or decrease, and when you're making a payment and your balance is going up, you're going to get underwater really, really quick, and that's exactly what happened with a lot of people.
Yep.
Yep.
So then you probably did a lot of the Harp Refinances or whatever, and that was kind of coming
Yeah,
out.
a few years after that came out, they basically, the Harp program, which essentially it gave an additional boost in the loan to value, and you could actually refinance a mortgage even if it was underwater, to save people money, to get them in a better loan product, to make their payment more affordable, so they didn't have to short sale or foreclose on their home.
Yep.
So that was big in like the 2011 to 2013.
Yeah, I remember
Yeah.
when that came out. It was crazy how many transactions there were going on with the
Mhm.
Harp.
Definitely.
What's kind of your general take on the market? Where do you think everything's going?
Yeah, great question. We get asked a lot, and I think that, after this last 2 years, we've had a crazy amount of appreciation. That is obviously not sustainable,
Yep.
From a housing standpoint, to keep up that pace that we're on. So I think going into 2022, 2023, I still think we're going to see appreciation. My guess would be anywhere between 5 to 8% appreciation, which is healthy. It's
Yep.
great.
Yep.
That means prices are still going up, but they're not going up at the rate that they were like when the pandemic started and everyone started freaking out and moving here and bidding prices up and all that
Right.
type of stuff. So I think mortgage rates are going to continue to go up. We've seen a little bit of an uptick in mortgage rates right now. So as those rates increase, that's going to kind of shrink everyone's buying power a little bit,
Yep.
and that's also going to help kind of slow the rise of home appreciation as we see that happening.
Yeah, love it.
Mm-hmm.
So kind of where the market's going and everything, do you see kind of, let me rephrase that. Where do you see your real estate partners, kind of the shift, kind of where their business is coming from, and kind of where you would suggest them kind of focusing their business to
Sure.
really
Yeah, the last
elevate?
2 years it was great to be a listing agent,
Yep.
and a lot of agents were like, you know what, I'm not even going to deal with buyers because they value their time, and for the last year especially, and then the even first part of this year, it was almost impossible to get buyers accepted. There was 20, 30, 40 offers on a house going 100,000 over list.
Yep.
So if you're representing buyers and that was your core focus, then you're showing dozens of properties, if not hundreds of properties, putting in 20 to 30, 40 offers on all these different houses and not getting anything into escrow. So at that point in time, it wasn't great to be a buyer's agent. All those agents were focusing on listings, with good reason. Now we're starting to see, certainly not a shift to the buyer side, but a little bit of a swing back to the neutral, still favoring sellers big time, but we're not seeing the 40, 50 offers on homes. 4 or 5 offers is still really nice if you're a seller.
Right.
So I guess for those agents that maybe neglected buyers in the last year and a half, it might be a good idea to kind of refocus on buyers. We're seeing offers getting accepted, and I think some of the sellers are relying on agents that maybe aren't as experienced, and they're kind of shooting not even the top of the market, but over the top of the market, which may have worked in spring of this year, but now we're starting to see some price reductions. People that are starting way too high, saying, "Wait a minute, this is a little bit aggressive. Let's back the price down." So I think a good thing would be to kind of refocus back on buyers, whether you have a buyer's agent on your team or if you're doing lead generation for buyers. So I think that we're moving more towards a balanced market, which is a good thing for everyone, I think.
Yep, I agree. Is there anything you're doing specifically to kind of coach your buyers or your buyer's agents on getting offers accepted?
Yeah, good question. So who they work with, obviously, for a realtor, title company, lender is super important in this market. Anything you could do to give yourself an advantage over the next buyer is really important. So what we tell our clients when they call in and they do an initial consultation with us is we really explain the advantage to getting everything turned in up front, doing a full underwrite on them up front. Yes, it's more work. Yes, it takes more time, and we understand that, but that's going to give them a leg up against that next buyer. And if I can confidently call the seller's agent and say, "Listen, my client John, we've got his W-2s, we've got his pay stubs, his income's already been approved through underwriting, we've got his assets verified. Like, all we need is title, insurance, and an appraisal, and this deal's done." That's going to give them a leg up, and that's going to certainly give them an advantage over other buyers that are just doing a very, I just saw a thing the other day, get a pre-qualification in 3 minutes. And it's like, 3 minutes? Like,
oh yeah, you're doing your due diligence,
yeah,
that's for sure.
What can really be accomplished in 3 minutes?
Right.
Like, if you're buying the largest asset of your life, you're going to work with a lender that's promoting, "I can get you qualified in 3 minutes." Like, I wouldn't trust a mechanic or a doctor or anyone that gave me 3 minutes of their time, right? So the quality takes a little bit more time. Not to say that we're going to take 2 weeks on an approval, but let's spend the time to really dial that in and make sure that we're not going to have any issues, during the lending process.
Really dive into your financials and make sure that you're actually going to qualify. So that way at closing, it's not any things that come up or whatever.
Exactly. Super important to do that. And we pride ourselves on giving options to the client ahead of time. So before they even make an offer on a house, they've got several options. And if they're concerned about funds to close and total money needed out of pocket, we're going to put together options that cater to that. And if they're more concerned with what's the lowest interest rate or what's the lowest payment possible, we're going to focus on that. Maybe even a 20-year mortgage or a 25-year mortgage to, pay down that equity a little bit quicker. And ultimately, I think everyone wants to own their homes outright eventually in retirement, so that's always a good thing too. So we really tailor our options that we provide to the client's goals.
Very cool. So kind of you're comparing all the different options and showing the break-even points. And
Exactly
choosing
right.
which different programs
Exactly
you choose.
right.
Love that.
I think it's very prevalent. Everyone is very rate conscious, which is, to be expected. But it's more than just an interest rate. If you're paying an arm and a leg to get that rate, and you're buying a starter house for the next 3 or 4 years, and your break even is 15 years, guess what? You're wasting a lot of money out of pocket or against your equity that you wouldn't have to. That doesn't make sense to do that. So we really educate our clients on, hey, how long are you going to be in this house, whether it's a purchase or a refinance, just to make sure that they're not spending when they,
My background with lending, that's probably one of the most influential or most, what's the word I want to use, valuable tools or things that I kind of took away from that side of things is like, okay, it's either cost up front or interest rate up front.
Right.
It's one or the other. And so it's okay. How long are you going to be in the house and what's your break-even time frame?
Right.
And figuring out what's best for your circumstance.
Exactly right. I say if they're working with someone that doesn't explain that, they are not working for that. They're just working for a commission and they don't care.
Yep.
We want to be with that client when they buy their second house, their third house, their first investment property, all of those things. And, we need to educate and make sure that they're doing the right things. And again, not overspending, making sure that if they're investing money, that they're going to get a return on that money and it's going to be the best product for them at that point in time.
Yep. I love that. Figuring out their goals and figuring out what actually fits for them, not just, hey, this is the best rate.
Here's your 30-year fixed rate like everyone else does.
Exactly.
Yep, exactly.
You brought up second home financing, investment properties.
Mm-hmm.
What kind of financing options do you guys do for those right now?
For a second home, we can do as little as 10% down.
Okay.
Investment properties are typically 20% down. However, you will see a little bit better interest rates if you put 25% down, and I know that's a lot, but that's kind of the way it's going. And really, the secondary market, the investors that buy these loans, they dictate really the paper that they want, and the way they do that is they make the rates more attractive the less risk there is. So on an investment property, if you have a little bit more skin in the game, that extra 5% down to get you to 25% down total really de-risks that loan for the investors, and they'll say, okay, well, we'll give you a better interest rate because we know if you have 25% down in that property, more than likely you're not going to let that thing go to foreclosure.
Yeah,
So we've
got a little more skin in the game.
Exactly right.
Love
Yep.
that.
Mm-hmm.
I know you guys have a second home now up in Payson.
Yep.
Tell us a little bit about that. It's pretty awesome. It's pretty cool.
I appreciate it. Yeah, it was. So we were stuck in our house last year, like a lot of people were, and this was kind of spring to summer of 2020, and we were kind of bored, and we're like, what the heck can we do? We can't really. At the time, we really weren't flying anywhere. COVID was a big concern then, and it's just like, what the heck can we do, to get out of town and maybe make an investment somewhere else? So we started looking up in Payson, and we, my wife's sister has a place in Pine Top, which is awesome. We'd love to go visit them up there. So we're like, okay, well, we kind of know the Pine Top area, and we have somewhere to go up there with family already. So that kind of,
don't need to get another place.
Don't need another place there. We considered Flagstaff as well, a little bit more expensive, and so we kind of landed like in Payson. It's a close drive for us, and only about 90 minutes to get there from our house or less, depending on who's driving the car.
Yeah, exactly.
But so it's been great. We closed on our place up there in August of last year, so just past a year.
Yep.
Do a lot of golf up there, a lot of hiking, a lot of outdoorsy stuff. So it's been really, really cool, and it's been a great investment for us already. And we're definitely going to be keeping that house for a long time, and I'd like to pass that down to my daughter and keep it in the family for a long time.
And you guys are doing family, friends, rental, some Airbnb.
Exactly.
Some kind of...
Yeah, we have to be pretty careful. There is an HOA there, so we have to be careful on what we're doing. But for the most part, we have friends, family, friends of friends that are, sometimes renting it when we're not using it.
Very cool.
So it's been really cool. Yeah.
And the golf courses up there?
Yeah, the Rim Club and Chaparral Pines are both amazing golf courses.
And someone's the new club champion up there, right?
Yeah, maybe.
Yeah. What'd you shoot?
So I shot 67 to win the club championship at Rim Club this summer. So
that's ridiculous.
That was my best score ever there,
okay.
And I kind of put it together when I needed to. So I was really happy with that. It was pretty awesome.
Yeah. I was actually talking to Cox about that.
Yeah?
He said that the guy you beat birdied one hole on 18,
and birdied number 9, and
you
I
eagled it or whatever.
Yeah. It's pretty filthy. Yeah,
that's pretty nasty. Yeah.
So I definitely went out and earned it. So that was cool to be able to put a really good round together when it really mattered. So
love it.
Pretty cool. Yeah.
So yeah, if you need a good lender and a good golfer, if you ever have any charity golf events or whatever, and you want to actually go win the tournament, this is the guy you need to pick up.
Yeah, I think we took home the W on Friday too at the
at Night Flight. That's right. I saw that. Yeah. Thank you for playing.
You bet. Some of those strokes were purchased, but it's for a good cause. So
they all count.
Why not? Right?
Hey, everyone else could purchase them too.
Yep. That's right.
It's all part of the game.
So that was a lot of fun.
That was a good time.
You guys did a great job putting that on.
Thank you.
Yep.
If you guys aren't familiar, we just hosted an event called Night Flight, part of a group called the Scottsdale 2030 Club, local philanthropy here in town. Actually going to be having some of the guys that are running the upcoming event, Agents Benefiting Children, on here in a few weeks. So you guys will be seeing more of them. But Trent Hancock and Evan Wisher are actually running Agents Benefiting Children and Brokers for Kids coming up here in the fall. So excited to be having them on here in the future. But
very cool.
Thanks for bringing that up.
Yeah, absolutely.
Yeah, we just had our Night Flight event. We actually surpassed $1 million raised.
That's incredible. You guys,
pretty cool.
Very, very cool. Yeah, well done.
Last year was $630,000. So to beat it by 1/3 or whatever was pretty awesome.
That's really, really cool.
I think it's a tribute to kind of Arizona's market right now, and everyone's got some money to spend and support the community and stuff.
That's great. It's going towards a great cause, and yeah, definitely. That was very, very cool.
With kind of what's going on in Arizona, where do you see kind of the building going? I mean, there's just really not much action going on right now. And
yeah, it seems like everything's going out.
Yeah,
we can't really go up, so everything's going out. So, down towards Santan Valley, out on the west side, Goodyear, Buckeye, and even past there, we're seeing some building, in the very extreme north part of Phoenix as well. So, yeah, it seems like, there's some new communities popping up within the, central corridor.
Yep.
But they're kind of few and far between.
And stuff,
Right. So they're, a lot of existing homes getting redone, which is cool. So we love to see that. But yeah, the building is going out for
Yeah.
sure. So if you want that new home and you don't want to pay an arm and a leg, you're probably going to have to be a little bit outside of the main part of town.
What percentage of your deals are new build versus resale?
Yeah, good question. We had one builder that we worked with. They just finished their product in Chandler, Waterfall Condominiums. We were a preferred lender with them,
Okay.
and they just finished out their build, and we had a lot of clients from there, so that was really cool. And we occasionally work with builders and clients that are buying new builds.
Yep.
As a percentage, I'd say maybe 5% of our business, so it's a small portion of it.
I know a lot of times they try to have like their own in-house.
Exactly.
Same
Normally,
thing with title.
exactly right. So normally they do have their in-house lender, in-house title company. Sometimes we can compete with them. Sometimes we're not even close, to be honest. And
Kinda same
we're
with us.
going to tell the client, listen, you're better off going with them. We can't match that. I mean, we can't make 10,000 come out of thin air. It just doesn't work that way. And
Yep.
so we're going to be honest if that does happen. But with the rise in prices, we're seeing the incentives for lenders either being reduced or taken away completely. So that gives opportunity for independent guys like us that don't have a formal agreement with that builder to get in and help those clients with their financing.
Yep.
And even though some of the builders are stopping to pay co-brokes to buyer's agents because they're like, you know what, we technically don't need you to sell these houses because the market's so crazy. So definitely some changes on the new construction front too,
Yeah.
which I always advise to have an agent present because that person represents the builder, not you. And it is kind of unfortunate that they're dictating that. But if you have the opportunity to have a realtor and a buyer's agent, I would definitely do that and
Yep,
protect
absolutely.
yourself.
Yeah, even though it's a new build, like an inspection is still
Plenty of stuff
important,
can
and
go
there's still
wrong.
plenty of things that you could be negotiating after that contract goes through.
Yeah, I can name countless things that I've seen, like lots changing. Just they ordered a custom front door, and then that custom front door wasn't, they paid for it, but it wasn't installed.
Yep.
I mean, things that you have to keep your eye on, and to have a buyer's agent there is definitely going to help. So hopefully we see some of those builders saying, you know what, maybe we were wrong about this. We're still going to compensate the buyer's agents, but time will tell, I guess.
Yep. How about what proportion of your deals are out of town buyers?
Out of state relocating
Yep,
here,
yep.
I would say probably 10-15% are
Yeah.
people moving here. A lot of people from California, a lot of people from the Midwest,
Yep.
some from Washington State and Oregon. So yeah, we have a lot of people not just buying their primary residence here, but a lot of second homes here too. So yeah, we're definitely seeing that quite a bit, way more than in years previous. So it's cool to see people moving to Arizona.
Yeah, it's
Yeah.
awesome. Yeah, I was sitting in an open house the other week, and I think we had 3 couples come in from California.
Yep.
It was just crazy. I'm like, okay, it's the real deal right now.
Yeah.
Literally everyone is moving here,
It is
whether it's California or Texas.
a lot of
or
Texas people
whatever.
too. Yeah.
For whatever reason, Arizona is the spot right now. It's
Yep.
pretty cool. It's good to be in the real estate market right now.
It definitely is. And, a lot of people are like, oh my goodness, I can't believe the prices. Well, if you compare to California, New York, East Coast,
Still
you
cheap.
still get a lot of value here, and we get amazing weather. I mean, a lot of opportunity here.
Yep.
Tech companies coming to town and opening up huge, warehouses and huge facilities that are, so that's big for jobs, and it's big for our economy. And I think, overall for the whole package to buy in Arizona, I think you still get a lot of value versus other areas that are
Well,
similar.
and it seems to me too like buying is a no-brainer. Is the cheap way to go right now because rents have just gotten insane.
Yeah, rents have increased even more than property values. It's insane how much they've come up.
We have a friend that is Airbnb his property, and he's getting like $20,000 a month. It's a 4-bedroom, 3-bath house. It's a nice house, but it's nothing amazing. So it's literally like, okay, I told my wife, we're probably gonna get our house ready to Airbnb and like throw some crazy number up there, and
Right.
who cares?
Especially with the Super Bowl coming and
Yeah,
Phoenix Open. Yeah, there's some.
spring training and everything. And
Yep.
she's like, well, where are we gonna go? I'm like, I don't care.
We'll figure it out. Yeah.
Like maybe we'll go buy another house. Like if we get 15,000, 20,000 a month,
It's
like,
insane.
we will figure it out.
It's insane. Yeah, yeah. My wife and I do own a couple Airbnbs in Scottsdale.
Okay. Where are those
as well. South Scottsdale, and we have one at McDonald and Hayden, and one at Thomas and Granite Reef.
I've seen the McDonald Hayden one. That's one of the ones with like the walk up off the street.
It's right off the
walk-up
green
front door.
belt.
Yep.
Yep.
Yeah.
Mm-hmm.
How are those doing?
Really good.
Okay.
Yeah, so we did pivot slightly with COVID. So last year, with all the uncertainty and people not traveling as much, we're like, shoot, like we don't want to just kind of sit on these and hope, we get one reservation every 2 or 3 months. Like that's obviously not cost effective to do that. So we then turned it to like a 30-day minimum.
Okay.
And we were lucky to find some. Actually, we had a client that we rented our other one, the South Scottsdale one, to where their insurance company found us on Airbnb. Even though we had a 30-day minimum at the time, they had fire damage at their house, substantial, renovation and just rebuilding and everything.
Yeah.
And the insurance company, they just gave us the asking rate and they didn't negotiate. They just were like, here you go.
Yeah.
And so we're like, wow, that turned out really nice. And they've been there almost 6 months. So we were getting almost an Airbnb rate,
Yep.
but for a 6-month rental. And so that turned out fantastic, and we're kind of glad. And we may turn it back to just a strictly like weekends or book whenever, that type of thing. But
Yep.
it's as a 30-day minimum, it's been going great. So we're just gonna keep it like that for now.
So that's exactly what my buddy that I was just talking about was doing. And so he just had it on there for a 30-day minimum, and he was like, yeah, I didn't need to rent it. Like, I don't care.
Right.
And all of a sudden there was a California buyer that was building a new house in Paradise Valley.
Mm-hmm.
The build got delayed. Shocker.
Yep.
Building's getting delayed right
Yep.
now because of supply and everything. And so now they needed a place to rent. And so they've been in his house for the last 4 months, and they just asked him to extend. And he went outside of Airbnb on this one for the last month.
Perfect. Yep.
Which he's now making more money
Yep.
on.
Not paying all the
I didn't
silly
believe
fees.
him. He literally,
Yep.
I was like, show me the
Show me the
statement.
money.
Yeah, literally. And he pulled up the statement of 3 months, and it was 56 grand after taxes and fees. And I was just like, okay,
It's incredible.
that's pretty good cash flow. I think I might consider this
Right.
now.
Yeah. Very, very cool. And so when we originally got in, and she lived in the house that we now Airbnb,
Okay.
and then we got together, built our house together, got married, starting a family, and so we kept that one as a rental, and so that was our first one that we had as an Airbnb. And our assumption at the time was, it's only going to be people coming for a long weekend, maybe bachelorette parties, maybe a work trip, this and that. But to your point, so many people are building, so many people are renovating. They need, and I would say more than half of our clientele for the Airbnb has been people that have been waiting for their house to be updated or built.
Yep.
And with the delays in the supply chain and construction and materials and labor, et cetera, et cetera, et cetera, things just take longer than people anticipate. And there's a huge need for short-term housing that's furnished,
Yep.
not moving twice. They just get their stuff, go there, they're good to go, and then they can just check out whenever their property's completed. So there's a huge need for that right now. So it's not just the people coming in to visit, which is a big portion of it, but it's a lot of people locally that are building and need somewhere to go.
And I almost feel like the full month is almost like the way to go right now, because like think about all the people that are relocating here that need a new place to live, need a new home,
Right.
But
They need at least 30 days, if not more. Right?
Yeah, I mean, they don't even know like what Scottsdale's about. Maybe Scottsdale's not even for them, and so they go,
Right.
okay, just because my office is here doesn't mean I need to live here. Like maybe I live here for 30 days and figure out what part of town I
Right.
really want to be in,
Exactly.
and kind of get my roots here before I actually buy something.
Right. Exactly.
So especially when you're relocating for a company, your company's paying for that.
Right.
Like you don't give a shit.
Yeah.
Like hey, yeah, my company will
Charge
write
that
the
company
check.
card.
Like, I don't care.
Exactly. Yep.
And they're committed to that at some point because you're going, hey, here's what's like compared to my property back where I came from.
Right.
And okay, just because it costs this much in Arizona, I don't care.
Exactly.
Like, you expected to pay your company to pay for that.
Exactly. Another component too that's a little bit overlooked, and especially for people that maybe are considering buying a house for an Airbnb or a short-term rental.
Yeah.
For Scottsdale in particular, they now have a Airbnb tax. And we kind of played the game a little bit, and then eventually we got something in the mail, and we're like, dang it, they got us. So the wording in that is basically it's under 30 days. So if you're specifically renting your property out for less than 30 days at a time, they consider that more of a business. They want you to register with the city of Scottsdale to have that business entity, and they want roughly a 6 to 8% tax.
Yeah.
And so if you are paying a property manager, they're typically getting 15 to 25% for all of your bookings.
Yep.
Now you're throwing another 7 to 8% in a city of Scottsdale tax. That gets expensive.
Yeah.
So if you're doing it for 30 days or more, that tax doesn't apply. So that's a good way to kind of get around that, and net more money as a investor and as a landlord, and not having to pay that extra tax.
Do you guys manage them yourself?
We're self-managing currently, yes. If we get any more, we'll probably hire a property manager.
I feel like once you get like past like 3 to 5 kind of range, it's like okay, this is too much now for me to handle.
Exactly.
Like 2 or 3, it's like okay, this is kind of manageable.
Exactly. Another good point too is if they're all extremely short-term, 30 days or less, you have a lot of turnover.
Yep.
You need to schedule lots of cleanings. Things are going to happen. Things are going to break. People are going to want stuff. Where if you do that 30 days or more, that kind of alleviates a lot of that turnover and
right.
a lot of that
Cleanings and
short-term
everything.
like work. So it's not a bad option. So.
And then are you since you're doing 30 days, are you collecting a lot bigger of a deposit up front for the 30 days?
Yeah,
or is it
we're
the same
doing
as if you were to do like a weekly.
Yeah, we're doing a little bit more of a deposit on the longer term stays. They get a break overall for the length of time because it's 30 days versus like a weekend. So their nightly rate is a lot less, but we are taking a larger deposit than we would if it was just like for a weekend stay type of thing.
Love it.
Mm-hmm.
Well, Brian, thanks for joining me today.
You bet.
It was awesome having you on.
For sure.
Why don't you tell everybody how they could get a hold of you for any financing needs?
Sure, definitely. So they can email me at B as in boy, so B Gething, Gething, at peoplesmortgage.com, and that's peoples with an S, peoplesmortgage.com. So bgething at peoplesmortgage.com, or give us a call or text 480-818-5856. Again, 480-818-5856.
Awesome. Thank you, Brian.
Appreciate it. Thanks for having me.
And stay tuned for another episode of Break It Down with Braydon. Thank you so much, guys. Stay tuned.